Everyone wants to achieve financial security and freedom, yet 70% of lottery winners end up going broke. 78% of NFL players go broke just a few years after retiring, and only 33% of millionaires earned more than $100,000 a year. So, what should that tell you? When it comes to finance, there are two very distinct skills that are necessary usually to become successful. That's making money, of course, and managing money. I'm Kerry Green, financial advisor and co-founder of Green Era Financial, and in today's video, I'm going to cover 3 of the best money management tips that I have that I think can be of value to anybody. The first tip here is to divide your finances up by the past, present, and future. And this is a very simple approach, but it can be extremely powerful and helpful to you. So here's what I mean by that. The past is defined as past obligations, mainly debts, right? Previous obligations, you have student loans, credit cards, mortgages, car loans, etc. The present would be your current income and your budget. And the future is building retirement wealth, buying that home you want, taking that dream vacation, etc. It's basically future goals that you have. Now, this is very simple. It's extremely hard to focus on the future and building your future when you're stuck in the past, right? And this is also why you see a lot of financial gurus like the Dave Ramseys of the world talk about, you have to pay off every little penny of debt that you have and be totally debt free and don't go into debt, etc. Because there's some truth in that. It's very difficult to build the life that you want when you're stuck addressing those obligations that you take on that can have a really heavy weight on your finances. Now, I'm not saying that you should pay off every single penny of debt that you have, and I don't really believe that to be true. But if you're stuck in the past, if debt payments are consuming a large portion of your monthly income, for example, making it very difficult to build retirement wealth or do the things that you want to do that you work hard to accomplish in your life, then you have to work out a way to increase your income or get your budget under control so you can take enough money, put it towards your debts, and get out from the past so you can now focus on the future. And that would be the first tip, is to divide your finances up and look at it from that perspective, because it helps bring clarity and a little bit of a plan of action of, okay, what do I need to handle? What do I need to fix? What do I need to get out from under from the past so I can really create on the future? Which brings me to tip number 2, the gradient approach. Now, this is very simple, but it's also probably the most important tip that I have here. And it's also the biggest failure that I see people have. And here's what I mean by it. Oftentimes people get excited. They go, okay, I'm going to handle my debts, or I'm going to start saving money for the future, for retirement, or whatever it is. And they go, okay, I'm going to save $500 a month or $1,000 a month or whatever it is, which is awesome. But generally speaking, they do it for a couple of months and then they fail. Well, why is that? It's very simple. They didn't approach it on a gradient. You haven't had a chance to adjust your spending and your lifestyle to accommodate this additional expense, which is really savings or putting extra money towards those debts. And there's a trick to this, and it's really, really, really easy to implement. If you want to have really consistent success in putting extra money towards debts or saving money every month, do it on a gradient. In the first month, save 1% of your income. If you make $4,000 a month, save $40. The next month, up it to 2%. And then the next month, 3%. And then the next month, 4%, etc. until you're reaching whatever your goal is. Maybe that's 10% of your income or a fixed amount of $1,000 or whatever that is. And if you do it this way, within 6 months, within a year, you have a chance to adjust your lifestyle on a gradient scale to accommodate for not spending that extra money, or spending that money you were spending that wasn't extra, and having a chance to save that money for whatever your goals are. So that's tip number 2. Now, number 3 is probably the most controversial tip here, and it's to pay yourself first. Now, when most people approach their personal finances, what they do is they take whatever income they're receiving from their job or their business or whatever it is, and the first thing they do is they allocate it out to all of their bills and their expenses, their mortgage, rent, car payment, insurance, utilities, food, etc. And then whatever's left over, if there is anything left over, that's for savings or for, fun or whatever it is, right? But what tends to happen, especially in today's society where there's a never-ending amount of things to spend money on, right? There's trips to the Bahamas, there's Starbucks Frappuccinos, there's new frying pans, there's, that ad that you keep seeing on Instagram that just finally got to you or whatever, right? There's a never-ending number of things to spend money on. And so more often than not, people at the end of the month don't have anything left. And that's totally okay. But there is a solution to that, which is to pay yourself first. So here's how it works, and here's how I apply it. I'm self-employed. I have my own business, right? When I receive income, the minute it goes into my bank account, the first thing I do is I take a portion of that money and I put it into my savings or investments. And I have it, basically determined by percentage because my income varies. But if you're on a salary, you could do this as a fixed amount, right? And I take that amount and I save it. And then whatever's left over is what I have to work with for that month. So if I make $5,000 arrives into my bank account and I'm taking, let's say, 500 of it, which would be 10%, and I save and invest it, I've got 4,500 left over to cover my bills and my expenses, my utilities, until the next chunk of income comes into my bank account. Believe it or not, this approach, when you first implement it, is really stressful because you're like, wow, what if I don't have enough money left? What if I run out? What am I going to do? Well, two things. Number one, you have that money set aside. You can always access it if you really need to, right? And number two, I've never run into the situation, and all the people that I've had implement this strategy have never run into the situation where they didn't have enough. We figure it out. Maybe we just don't go on that trip to the Bahamas or buy that new set of frying pans or, the whatever it is, right? And it's a way to address your finances where you can basically guarantee that you're always paying yourself first rather than paying everybody else first and making everybody else rich before you make yourself rich. So if you can do this, if you can approach your finances by looking at the past, present, and future, and getting yourself out of the past so you can really handle the future, you do it on a gradient approach and you pay yourself first. Those three tips, if properly implemented with determination and some discipline, can totally change your life financially. And it is one of the tricks or one of the secrets or one of the ways that a lot of these people who have achieved $1 million net worth or more without ever having earned a huge amount of money are able to do it is by just applying these three money management principles. Hope this helps. If you have any questions, please just drop them in the comments down below and I'll get back to you. And if you're interested in finding out how we help our clients at Green Era Financial to get the most out of life with their money, then visit us at greenerafinancial.com. See you next time.